Let's be honest, when you hear interest rates, it's easy to switch off. It sounds like one of those dry financial terms that only matters to bankers or economists. But here's the thing, interest rates are actually at the heart of almost every money decision you make, whether you realize it or not. But stick with me, this stuff shapes your daily life. Every time you buy something on credit, save for a holiday, or even just pay your bills, interest rates are quietly working in the background. Think of the Bank of England as the UK's financial thermostat, keeping the economy not too hot, not too cold, but just right for everyone to thrive. Its main tool? The bank rate, the interest rate it charges other banks to borrow money overnight. This might sound technical, but it's the starting point for all the other interest rates you see, from your savings account to your mortgage. This single rate influences everything: your savings account, your mortgage, your credit card, even car loans. When banks pay more to borrow money, they pass those costs on to you, the customer, in the form of higher interest rates on loans and sometimes better rates on savings. When the bank rate goes up, borrowing gets pricier and spending slows. People might think twice before taking out a loan or splurging on big purchases. When it drops, borrowing is cheaper and spending picks up, which can help boost the economy if things are sluggish. Imagine saving for a flat. High rates mean your savings grow faster, but borrowing for a mortgage costs more. It's a balancing act. What's good for savers can be tough for borrowers, and vice versa. The Bank of England has to balance these pros and cons for millions of people. Every decision they make affects households, businesses, and the wider economy, so it's a huge responsibility. The main reason for changing rates: to control inflation, the rate at which prices for things like groceries and bus tickets rise. If inflation gets out of hand, your money doesn't go as far, and everyday life gets more expensive. The bank aims to keep inflation around 2%. That's their sweet spot, high enough to encourage spending and investment, but low enough to keep prices stable. If prices rise too fast, they hike rates to cool things down. If the economy's sluggish, they cut rates to encourage spending. It's a bit like adjusting the thermostat in your home. Too hot or too cold, and things get uncomfortable. It's all about finding that sweet spot for a stable economy. The right interest rate helps keep everything in balance, so people can plan for the future with confidence. So, interest rates aren't just for bankers. They're the invisible force shaping your financial world, quietly influencing your choices, your opportunities, and your everyday life, whether you notice them or not. Now that you know what interest rates are and why they matter, let's dive into what's unfolding in the UK right now. The financial world is buzzing with anticipation, and all eyes are on the Bank of England. The big news? The Bank of England is widely expected to cut its main interest rate this March, from 3.75% down to 3.5%. This move is making headlines and stirring up plenty of debate among experts and everyday people alike. At first glance, a 0.25% cut might seem tiny, almost insignificant. But in reality, even a small change like this can send ripples throughout the entire economy, affecting everything from the cost of borrowing to the value of the pound. According to recent polls, over 60% of top economists believe this cut will happen at the bank's March 19th meeting. That's a strong consensus, but it's not unanimous. There's still plenty of uncertainty. The decision isn't automatic. It comes down to a vote by a 9-member committee, each weighing the risks and rewards. Last time, the vote was a razor-thin 5-4 split to keep rates steady, showing just how divided opinions are. This close call highlights the strong arguments on both sides. Some members want to support the fragile economy and help households struggling with high costs, while others worry that cutting rates too soon could reignite inflation. If the cut goes ahead, it's a clear signal the bank believes the worst of the inflation crisis is behind us, and that it's time to start easing up on the brakes. For you, this could mean lower monthly payments on your mortgage or loans, making it a bit easier to manage your household budget. But it also means savings accounts might earn even less interest, so it's a mixed bag. Whether you're a homeowner, a saver, or just trying to make ends meet, this decision marks the start of a new chapter for your personal finances. It's a moment to reassess your plans and think about your next steps. The bank's next move could shape your wallet and your financial future for years to come, so it's worth paying close attention to what happens next. Why is March the likely moment for a rate cut? It's not random. Experts are reading the economic signs. The UK economy barely grew at the end of last year. It's like a car struggling uphill. Rate cuts are like pressing the accelerator to help it along. High rates were used to fight soaring inflation. But now inflation is cooling. Keeping rates high for too long could tip the economy into recession. Think of high rates as a fire hose. Once the fire's out, you don't want to flood the house. The bank is shifting from fighting inflation to helping the economy recover. This is a forward-looking move, aiming to support growth in 2026. Cheaper borrowing should encourage businesses to invest and shoppers to spend. It's all about keeping the wheels of the economy turning. Most experts agree on a March cut, but after that, it's anyone's guess. Economists are split. Some expect another cut by June, others say not until later, or not at all this year. The Go Faster camp wants to boost growth and jobs, arguing inflation is mostly behind us. The cautious side fears cutting too soon could reignite inflation. Even inside the bank, opinions are divided. Recent votes have been razor-thin. The bank's chief economist warns against moving too quickly while inflation lingers. This uncertainty makes it tough for businesses and homeowners to plan. Every decision is on a knife edge, and the path ahead is far from clear. The debate shows just how tricky balancing growth and inflation really is. Nothing is guaranteed, so stay alert. So, what's the big deal with inflation? It's a word we hear all the time, but why does it matter so much to our everyday lives, and to the big decisions made in the City of London? Inflation is the rate at which prices rise, and lately, it's been stubbornly high, squeezing household budgets and making everything from groceries to energy bills more expensive. The Bank of England's official target is 2%, but right now, inflation is hovering around 3%. Experts warn it could stay above target well into 2027, making it a persistent problem for policymakers. Some economists, like James Rossiter, expect inflation to stick near 2.5% for a while, which means the pressure isn't going away anytime soon. The big worry is that if interest rates are cut too soon, people might start spending more, which could push prices up again and undo the progress made so far. It's a bit like dieting. One treat is fine, but too many, and you're right back where you started, struggling to keep things under control. The bank is weighing up whether the economy can handle a treat in the form of lower rates, or if it needs more discipline to keep inflation in check. Underlying inflation, which strips out the most volatile prices, is still running above target. That means the job of bringing inflation down isn't finished yet. That's why some inside the bank urge caution, warning that moving too quickly could backfire and make things worse. This lingering risk of inflation means the future path for interest rates is more uncertain than ever, leaving businesses and families guessing what comes next. The battle against inflation is far from over, and the choices made now will shape the UK's economic future for years to come. So, what does a rate cut mean for your money? If you have a variable rate loan or tracker mortgage, your payments could drop, maybe $25 a month on a $200,000 mortgage. Fixed-rate mortgage holders won't see changes until their deal ends, but future deals may be cheaper. Personal loans and credit card rates may drift down over time. On the flip side, savers will see lower interest. Banks pass on cuts quickly. If you rely on savings interest, this can squeeze your budget. The bank's goal: make borrowing cheaper and saving less attractive, nudging people to spend. More spending helps businesses grow and supports the economy. The rate cut is a signal. It's time to think a bit more about spending, if you can. Your financial habits may need a tweak. Let's zoom out. How's the UK economy doing overall? In a word, fragile. Growth was flat at the end of 2025, and the economy is still recovering from high rates and a cost of living crisis. That's why a rate cut is on the table. Forecasts predict slow, steady growth, about 1% in 2026, rising to 1.4% in 2027. It's not a boom, but it's better than shrinking. The bank wants to support this gentle recovery and avoid a stall. A rate cut is a powerful tool, but not a magic fix. The UK faces other challenges: global trade, productivity, and more. The rate cut is just one piece of a bigger puzzle. It's a helpful nudge, not a cure-all. Real recovery will depend on many factors, not just interest rates. The journey back to economic health will take time. So, what should you actually do? Savers. Shop around for better rates. Don't let your money languish in a low-interest account. Consider locking in a fixed-rate bond or cash ISA before rates drop further. Borrowers. If your mortgage deal ends soon, start looking for new offers now. A rate cut could mean more competitive deals, so be ready. If you have a variable rate mortgage, enjoy the lower payments, but consider fixing for certainty. Check your other debts. Credit cards and personal loans may not get cheaper as fast. Look for balance transfer deals to save on interest. Draw up a simple budget. Know what's coming in and going out as your financial picture shifts. Being proactive now can save you money and stress later. What should you keep an eye on next? Mark your calendar for March 19th, the Bank of England's big decision day. Pay attention to their statement and how the vote splits. It reveals their thinking. Watch monthly inflation figures. If inflation falls, more cuts could follow. If it's stubborn, expect caution. Listen to what bank leaders say in speeches. They often hint at future moves. These clues help you anticipate what's coming for your money. Stay informed and be proactive with your finances. The economic weather is changing. Adjust your sails. Don't just drift. Take small, practical steps to protect and grow your money. If you found this helpful, subscribe for more practical finance lessons.